You're scrolling through listings on a Saturday morning, coffee getting cold, the house is fine. Not perfect, but fine. $400,000. You run the calculator for the 15th time this month. Monthly payment hovers around $3,000 after tax and insurance. Your household brings in $9,000 a month before taxes. The math says yes, but your chest feels tight anyway. You close the laptop, tell yourself you'll think about it tomorrow. But tomorrow, the same feeling returns. Something about the numbers doesn't line up with the life you're picturing. Not the house itself, the life around it, the buffer, the breathing room, the version of stability you thought hitting six figures would deliver. Most conversations about housing affordability start with income multiples. You've heard them. Don't spend more than 3 times your salary. Keep your mortgage payment under 28% of gross income. The 36% debt-to-income rule. These benchmarks sound official, reasonable, like rules designed to protect you. And they are. In a narrow, technical sense, lenders use them to predict whether you'll default, whether the loan is safe for them. But safe for the lender isn't the same thing as comfortable for you. The rules were built to measure risk on a balance sheet, not stress in your actual life. They don't account for what happens when your kid needs braces, your car transmission fails, or your company announces a hiring freeze 3 months after you close. This is where the gap lives, between what you can technically afford and what you can afford without constantly calculating. A $400,000 house isn't unaffordable because the math doesn't clear. It's unaffordable when the math clears, but nothing else does. The assumption most buyers carry into this process is that if the bank approves the loan, the house must fit their life. If the payment is 30% of income instead of 40%, it must be sustainable. This belief feels logical. Banks have access to data, algorithms, decades of lending history. Surely they've built models that account for real-world conditions. They haven't. Or, more precisely, they've built models that account for their conditions. Whether you pay the loan, whether the collateral holds value, not whether you can take a vacation in year 3, not whether one partner can step back from work when a parent gets sick, not whether you'll lie awake at 2 a.m. doing mental math about daycare and property taxes. The bank's definition of affordability stops at the payment. Your definition includes everything the payment touches, and those two definitions almost never align. Here's the reframe. Affordability isn't an income threshold or a debt ratio. It's a question of remaining capacity, not what you earn, but what you have left after the fixed costs lock in. A $400,000 house doesn't become unaffordable at a certain income level. It becomes unaffordable when it consumes the part of your budget that absorbs uncertainty. Think of it this way. Every household has 3 layers of money. The first layer covers essentials: mortgage, utilities, insurance, groceries, minimum debt payments. The second layer covers discretionary life: restaurants, travel, hobbies, the occasional impulse purchase. The third layer covers shocks: medical bills, urgent repairs, job loss, economic downturns. Most affordability calculations only care about the first layer. They ask, can you cover the essentials? If yes, approved. But life doesn't happen in the first layer. Life happens when the second and third layers get squeezed. When discretionary spending isn't truly discretionary, because your nervous system has been in low-grade fight or flight for 18 months. When shocks aren't theoretical, they're the reason you're now comparing high-yield savings accounts at 11 p.m. on a weeknight. A house you can afford is one that leaves the second and third layers intact, or at least, mostly intact. A house you can't afford is one that forces you to merge all 3 layers into one razor-thin operating margin, where every month feels like controlled falling. You're current on everything, never late. But never comfortable either. This dynamic is invisible to the system because the system doesn't track comfort. It tracks performance. And you can perform right up until you can't anymore. The mechanism that makes a $400,000 house unaffordable isn't the house itself. It's the way the house interacts with everything else that's also getting more expensive. Property taxes reset every few years. Insurance premiums climb. Maintenance isn't optional. It's a variable you can't control. And all of this happens while your income grows slower than your cost of living, while your employer shifts more healthcare costs onto you, while inflation quietly recalibrates what normal spending looks like. The cruel part? None of this feels like a housing problem when you're living it. It feels like a you problem, like you're bad at budgeting, like everyone else figured something out that you missed. But the truth is structural. Housing costs have outpaced income growth for 2 decades. Wage growth concentrates at the top. Middle-income households are earning more than they did 15 years ago, but their purchasing power is lower. A $400,000 house in 2026 isn't the same financial commitment as a $400,000 house in 2006, even if the dollar amount stayed frozen. The invisible mechanism is this: the cost of stability has increased faster than the means to acquire it. And because housing is the largest fixed cost most people carry, it's where the squeeze surfaces first. You're not imagining it. The math isn't lying to you. You're just being told the math ends at approval, when really, it's only beginning. Let's walk through what this actually looks like. Not a worst-case scenario, not a best case either, just a realistic middle. Household income, $130,000 a year, gross. After federal, state, and payroll taxes, that's closer to $95,000 take-home. Roughly $7,900 a month hitting your account. Not struggling money. Not rich either. Comfortable, if you're careful. You buy the house, $400,000. Put down 20% because that's what you've been told to do, if you can. $80,000 from savings, leaving you with a $320,000 mortgage. At a 6.5% interest rate, that's about $2,100 a month in principal and interest. Property taxes in a typical suburban area, another $500. Homeowners insurance, $200. So you're at $2,800 before you've turned on a single light. But you're not done. HOA fees if the neighborhood has them. Let's say $150. Utilities, internet, trash, water, gas, electric. Another $350 conservatively. Now you're at $3,300. Maintenance reserve? You should be setting aside 1% of the home's value annually. That's another $330 a month. We're at $3,630. You still have a car. Maybe two. Even if they're paid off, insurance runs you $200. Gas, another $150. That's $350 more. $3,980 total. Groceries for a household? $500 if you're not eating out much. Health insurance premiums after employer contribution? $300. Let's add another $100 for copays and prescriptions. That's $900. We're at $4,880. You have student loans, not crushing debt, but $30,000 remaining at 5%. That's another $300 a month. $5,180. Round up to $5,200 for subscriptions, phone bill, occasional household essentials. You started with $7,900. You're now at $5,200 in fixed and semi-fixed costs. That leaves $2,600. But $2,600 isn't discretionary. It's everything else. Retirement contributions. You should be saving at least 15% of gross income, which is about $1,600 a month. Now you're at $1,000 left. Clothing, personal care, haircuts, kid activities if you have children, gifts, pet expenses, car repairs that will happen, the appliance that will eventually die, the fence that needs replacing. $1,000 to cover life. Not luxuries, just life happening at a normal pace. And here's the friction point. That remaining $1,000 isn't really yours. It's a shared pool between genuine discretionary spending and inevitable surprises. The week your kid gets sick and you miss work, the month your car needs new tires, the holiday season, the friend's wedding across the country, one moderately expensive month, and suddenly you're deciding whether to pull from the emergency fund or skip the retirement contribution. This isn't irresponsible budgeting. This is what happens when a mortgage consumes enough of your capacity that flexibility vanishes. You're not broke. You're just locked in. Every decision becomes a trade-off. Every surprise becomes a problem. And here's the part that nobody mentions when they're running affordability calculators. Your nervous system knows, even if the spreadsheet balances, even if you've never missed a payment. Your body understands that the margin is too thin, that you're operating inside a system with no give, that any deviation from plan means scrambling. This is why a $400,000 house at $130,000 income feels affordable on paper but suffocating in practice. Not because you can't make the payment, but because making the payment costs you optionality. And optionality is what makes life livable. The psychological shift isn't about lowering expectations. It's about recognizing what you're actually buying when you buy a house at the edge of your budget. You're not just buying the house. You're buying reduced flexibility for the next 30 years. You're buying a tighter margin for error. You're buying the feeling of being financially competent, but emotionally exhausted. People talk about being house poor like it's a temporary phase. Like once you adjust, once you get that next raise, once the expenses stabilize, it'll feel better. But expenses don't stabilize. They grow. Property taxes increase, insurance premiums climb, things break, kids get older and more expensive. Your parents age, life expands. And if you started with a thin margin, that margin doesn't widen with time. It narrows. Because the house payment is fixed, but everything around it is variable. And all those variables trend up. This is the part that sits in your chest when you're looking at listings. Not the fear of losing the house, but the fear of keeping it. Of spending decades in a state of low-grade financial vigilance. Of calculating before every decision. Of feeling like you can't fully relax because the system you've built has no slack. There's a quieter cost too. Relationships, partnerships. The number of arguments that start with money but aren't really about money. They're about stress. About one person wanting to book a trip and the other person already running the mental math on whether they can afford it. About different tolerances for financial tightness. About the growing resentment that comes from feeling like you did everything right, and it still doesn't feel sustainable. This isn't about blame. It's about recognizing that a house at the upper edge of your budget doesn't just affect your bank account. It affects your decision-making, your stress baseline, your ability to be present, and those effects compound, year after year, until you're 5 years in and you realize you haven't taken a real vacation, haven't switched jobs even though you're burned out, haven't had the second kid you wanted. Not because those things are impossible, but because the margin is too narrow to absorb any more complexity. So here's the reorientation. Affordability isn't about what the bank will approve, it's about what lets you live without constantly monitoring the edges. A house you can afford is one that leaves room for error, for spontaneity, for the version of life where you occasionally make decisions without calculating first. That might mean a $300,000 house instead of $400,000. It might mean renting longer than feels culturally acceptable. It might mean living in a different zip code or buying less house than your peer group. But the trade-off is this. You get to breathe. You get to absorb a surprise expense without catastrophizing. You get to say yes to things without immediately running the numbers. The question isn't whether you can afford a $400,000 house at a given income. The question is whether you want to spend the next decade of your life managing the gap between what you earn and what the house demands. Whether you want your financial life to be a permanent optimization problem. Whether you're willing to trade spontaneity for square footage. There's no universal answer. Some people run tight margins comfortably. They like the challenge, the structure, the forced discipline. But if you're the kind of person who feels their chest tighten when the mortgage calculator loads, that's information. Your nervous system is telling you something about your actual capacity. Not your technical capacity, your lived capacity. The brutal math isn't just the payment, it's the cumulative weight of operating at the edge, month after month, year after year, the math that says, you're fine. While your life feels like a controlled emergency, that's the math that matters. And it's the math most people don't run until they're already locked in. You can do everything right, hit the income targets, save the down payment, get approved, move in, and still feel like you're underwater, not because you failed, but because the house was never actually affordable in the way that makes life livable. It was affordable in the way that keeps the bank comfortable, and those two things aren't the same. The calm part is this. You get to decide what affordable means for you, not the lender, not the calculator, not the culture that says homeownership at any cost is the goal. You get to define the margin you need to feel steady, to sleep at night, to make decisions from a place of choice instead of constraint. That margin is different for everyone, but it's real, and it's worth protecting. Even if it means walking away from the house everyone says you should be able to afford,